Imagine this. Your portfolio's humming along. Stocks up 20% last year, bonds paying steady. Then one word from the Fed. Pause. Suddenly, bond prices tank 10% overnight, stocks wobble, retirement dreams flicker. That's the interest rate tsunami, and it's building right now. Why does this hit home in February 2026? The Fed just held rates at 3.5 to 3.75% in January. After 3 cuts in 2025, they stopped cold. Inflation lingers above 2%. Jobs hold steady, but not roaring. Markets bet on cuts. The Fed? Not so fast. Picture Sarah, mid-40s engineer in Seattle. Built a nest egg chasing 2025's rate drop rally. Loaded up long bonds, tech stocks, felt smart. Then Powell speaks. Data dependent. Her bonds drop 5% in a week. Tech dips on higher for longer whispers. Stakes rise. One decision ripples through trillions. How the Fed machine turns.
The Fed sets the federal funds rate. Banks borrow overnight at that price. 3.5 to 3.75% today. Lowers it. Money floods cheap. Economy heats. Raises it. Brakes slam. Inflation cools. They meet 8 times a year. Next, March 17th through 18th. Then April, June with projections. Dot plot from December 2025 shows median 3.4% end 2026. Just one 25 bitter percenters cut likely. But dots scatter. Some see hikes. 3 dissenters wanted cuts in January. Data drives it. CPI at 2.4% projected for 2026. Unemployment 4.4%. Powell's term ends May. Trump picks next chair. Politics simmers underneath. Tension builds. Solid GDP at 2.3% forecast, but inflation somewhat elevated. The hidden math that crushes portfolios. Rates up 1%? 10-year Treasury bond falls 8 to 10% if long duration. Why? New bonds pay more, old ones sell cheap.
Your 60-40 portfolio, 60% stocks, 40% bonds. Classic. Rates rise, bonds bleed. Growth stocks like tech crater. Future cash flows discount harder. Value stocks, banks, they thrive on higher margins. Numbers sting. Post-2022 hikes, S&P dropped 25%. Bonds lost 15%. Now reverse. If cuts stall, same pain flips. Sarah's math. $500,000 bonds at 4% duration. 1% rate pop. $20,000 gone. Compounded over months? Devastating. Irony here. Everyone chased cuts. Fed paused. Absurd how one dot plot shifts billions. Hype versus the brutal reality. Wall Street screams, cuts galore. CME FedWatch priced 2+ in early 2026. Reality, dot plot says 1, or none, or hikes if inflation spikes. Hype, soft landing forever. Reality, unemployment stabilized but job gains low. Inflation sticky. Markets up 15% on cut hopes. One hot CPI, 10% correction. Trump's back. Tariffs loom. Could reignite inflation. Fed independent? Watch closely.
By mid-year, next FOMC, June 16 through 17. Stakes skyrocket. Powell out soon. New voice. Volatility doubles. What if your bond ladder matures into lower yields? Reinvestment trap. Hype ignores that quiet killer. Hey, quick question. What's the one asset in your portfolio you'd dump first if rates spiked? Drop it in comments, helps us all think sharper. And subscribe. These Fed twists blindside most.
Stay ahead. Next video breaks portfolio fixes. Hit it now. The portfolio wrecking risks. One rogue CPI print. Tariffs jack prices. Fed flips to hikes. Tsunami hits. Bonds plummet. Equities waver. Tech first casualty. Real estate? Mortgages soar. Values stall. Cash? Earns less if cuts come. But safety net. Diversify smart. Short bonds now. Tilt financials. Energy. Barbell fixed income. Short for yield, long for cuts. Alternatives shine. Renewables, EM debt less rate tied. But volatility reigns. Risks compound. Powell exit. Election echoes. Inflation at 2.4% median, not 2%.
Is your portfolio ready? Extend duration only on cut signals. Rebalance quarterly. Favor cash flow kings over dreamers. But here's the gut punch. Dot plot hides hawks. 3 saw hikes. Unemployment ticks up. Cuts. Inflation? Hold. Sarah pivots. Trims tech. Adds banks. Shorts duration. Sleeps better. You? Audit now. Next meeting March. Tsunami brews. One question lingers. When the Fed blinks, or doesn't, will your money drown? Or ride the wave? Think on that. Thanks for watching. Love you guys.